economy in Europe, France, and then, of course, the giant of the European economy, Germany. So likewise, the pattern is the same. The worry level about default is clearly escalating. Many argue that, as I said, Europe may already be in recession. Hope is at least alive that the emerging countries, which have done so well over most of the past decade, will be able to pick up the slack, even if Europe and potentially the United States falls into recession. But that too is becoming increasingly questionable as you look at the next page about China, which of course is the leading of the emerging markets. This just was, I think I saw this yesterday, the ISI China Sales Survey. This again is an ISI study. China Sales Survey and consumer confidence are both weakening very considerably. And as this little study pointed out, in addition to these two readings, there have also been weaker readings in the past 2 weeks for M2, which is their money supply, bank loans, exports, business confidence, and house prices. So a real dip down for whatever that is going to mean. Another picture of Chinese economic stability is over on the next page, page 12. This, we're back to a CDS, again, a kind of a measure of the cost of insurance against a default by China. And here the numbers aren't so terribly important. It's, again, the pattern. The concern that people in the market are actually expressing right now has obviously spiked up quite considerably in this time period. It's not back to where things were at the trough of the economic crisis, but it's starting to move up fairly quickly. I continue to wonder why, with all the country's economic success, the Chinese stock market is still 60% below where it was 4 years ago. Now somebody's worried out there. It's hard to imagine China, which we've till very recently, where things have slowed a little, having a market that's 60% down from where it was in late 2007. And history will probably give us the answer, but it'd be nice to be able to foresee that a little bit in advance. Well, let's turn to the U.S. Goldman Sachs just last week came out and declared that the U.S. will not fall into recession. And, well, that's a strong level of conviction, but Goldman Sachs is a very prestigious, smart group of people. And they have made their case. The U.S. will not fall into recession. This page shows, again from ISI, ECRI, which is the Economic Cycle Research Institute. I always have to go back and check that because nobody ever says that anymore. You just see ECRI. They say that a U.S. recession is inevitable. So you've got two very reputable operations, one saying we're in the clear, maybe not that everything's going to be wonderful, but at least we're not going into recession. And Lakshman Achuthan, if you ever watch him, he's worth listening to. If you see him on television, he's a very sound thinker. He does a lot of good economic studies, and he's kind of the chief, I don't know what his title is, but he's the chief economist at ECRI, and they have a very strong track record of being accurate on whether the market's going to go into recession or leave recession and go to a rising environment. He says the way that their studies now read, that the economy has never escaped a recession when their data have reached the present levels. So there's a first time to anything, but that's at least fairly good historical precedent. And this graph shows the strong correlation between the ECRI economic leading index up here and the S&P 500. Now, if they're right, and this doesn't indicate how low the index might go, but there is a relatively good correlation between the two. You could be in a recession, as was the case here, and have it only go down a little bit farther. So it doesn't mean it has to go down there or anything like that if we do go into a recession. And the U.S. stock market, as you see over on the next page, is also forecasting a recession. While this is not infallible by any means, the signals coming from this Ned Davis research study have a 79% accuracy rating in terms of pointing for an economic decline or an economic rise. The gray areas, by the way, that you see on this and on some other graphs that we'll look at, these are periods of recession. So we're going back here all the way into the 50s, 40s? Where? 50, yeah. So we're looking at 60 plus years of data, and they've got a 79% accuracy rating. And right now, the U.S. stock market has dipped below its 8-month smoothing by a sufficient percentage to give them an economic sell signal. Now, a very ominous picture of economic prospects comes from a look at the stocks of the country's major banks over on the next page. We tend to concentrate our attentions into what has happened recently, but I expanded this back into the early to mid-1990s, and these are monthly graphs of each of the 4 big banks that we've profiled here: B of A, Citigroup, Morgan Stanley, and J.P. Morgan Chase. And when from the peak of the greatest expansion there, you've got B of A down about 90%. You've got Citigroup down about 95% from the peak. Morgan Stanley down about 80% from the peak. And then kind of the best of breed, which most people consider J.P. Morgan Chase to be in the banking group, that's only down just under 40% from its peak. So that's been the relative star of the group, but obviously in a very substantially damaged group. And this, of course, is after the monumental amount of governmental support that has been given to the banking industry. And it's rare when you think back historically, and not just in this country, but in countries generally, when you think back historically, it's rare to have a strong, healthy economy without a strong, healthy banking system. And so this, while we don't know what the outcome is ultimately going to be, whether this will suddenly arise and start going up substantially, right now at least the market is saying they don't have an awful lot of confidence, even though most individual analysts, if you listen to the comments from most individual analysts, even some that are very good. I was listening to Sean Egan this afternoon, whose views I like a lot. He said the U.S. banks are very strong. I mean, fundamentally they're very strong. The market doesn't agree at the moment for whatever the reasons. So we will see. Maybe there's the fear of Europe turning out much, much worse than what the European governments and bankers are trying to pull off there. And, of course, the contagion effect is very, potentially very strong. Many U.S. money market funds, and I'm sure that includes the money market funds involved with the banks and so on, pulled massive amounts of money out of the European banks because they're afraid that stuff is, even the short-term paper of the European banks is endangered. So we don't know. But clearly, when you see markets that are that low in a broader market environment, which is nowhere near its multi-year lows. I mean, we're not down where these banks are. So the overall markets are much higher than this. But for some reason, even after the government support, the infusions of new capital and so on, these banks are trading off at very, very low levels. There's really not an awful lot of confidence in the U.S. economy anywhere, and I'll kind of run fairly quickly through the next couple of graphs. Here we're looking at consumers worried, and the numbers themselves on the sides aren't terribly important. This is a Bloomberg Consumer Comfort Index. I've used it before. It's always good to see an update. Where are we today? And if you look, this is the index itself, and these are the components of the index down here. But at the top, you see where we are right now. We're pretty much right on the lows we've ever experienced in this period, which goes back about 25 years. So the consumer isn't confident. And you look below that, there's the state of the economy, then the personal finances, and then the buying climate. None of those is particularly strong. Some of them are a little farther off the bottom than others, but none is strong. Small businesses are also skeptical. If you go to the next page, this is the NFIB, National Federation of Independent Business, Small Business Optimism Index. And again, you have your gray lines here representing the periods of recession. And you'll notice where we are right now. And this was one of the little ISI news headlines. This was one of the two in the neutral column. The index had moved up. You can see a little blip up there. But as they said there, it's still weak. Well, weak is an understatement, for crying out loud. It's never been down in this level except in the middle of recessions. So, yeah, it's awfully weak. And so small business, people say, where are the jobs? Well, heck, small businesses don't have the confidence to hire people. And there are all sorts of reasons why that might be. My favorite is that there is no demand. So who's going to hire a whole bunch of people? You know, you hear an awful lot about government regulations, and I'm sure government regulations are a pain in the butt to a lot of small business people. But ultimately, you'll put up with some of that if you've got demand out there. And you can't, if you could sell more of your product or service, you'd do it. You'd probably put some more people in place, at least temps. But if there's no demand, you know, you can have, we talk about money that's sitting on corporate balance sheets. Why would they spend it if people aren't knocking on their door to buy their product or service? So this is to me, that's the fairly obvious reason why we're not seeing new employment. We just don't see people buying. Now, you're seeing some retail sales that are decent, but and I'm going to get off on that because I don't have stuff to show you on it. But basically, we're taking down savings. We're not increasing our revenues much into the consumer's pockets, so the consumer is drawing down savings again. And that's a big danger because here they are without jobs, their homes are no longer a piggy bank, and they're draining down savings. So this is a tough environment. The next page, University of Michigan, is probably the most widely followed of the consumer sentiment surveys. The survey itself is the top part here, and you can see where we are on that. Whenever we're even close to these levels, the country's been in recession. So you know, anything you draw across there, anytime you hit something, it's all in the gray area. It's all in recession. So clearly, one survey after another, the confidence isn't there in the economy. Major company CEOs are also worried on the next page. This is a conference board study. And most of the CEOs that they're interviewing in something like this are fairly large companies. So we were looking at small company stuff before. This is more skewed toward the large companies. And whenever the CEO confidence levels have reached this low a level, and you've kind of conveniently drawn a line here, corporate profits have been in decline. You can see that in the box up here where it shows, depending on where the confidence level is, what has happened in that time period to corporate profits. So we're at a point where the CEOs themselves are not confident, and that has typically corresponded to a declining profit environment. Let me turn away now from the consumers and business confidence measures to investor confidence. This one's a little different. This is an investor optimism survey, and consumer and business sentiment tend to have a tendency to lead to consistent outcomes. So, for example, if you've got negative sentiment, it leads to or foretells somewhat negative business results. Conversely, positive sentiment tends to promote positive business results. It's a little different when you start looking at investor sentiment because that's more of a contrary indicator, especially at the extremes. I mean, I shouldn't say especially. It is a contrary indicator at the extremes. In the broad middle, it probably is. I haven't really looked at the correlations in the middle. But at the extremes, investor confidence, investor optimism or pessimism tends to be a contrary indicator. And you can see where we are right now. We're down here in the pretty pessimistic area, which in general is a favorable environment for stock market progress. And you can see They've done the study of how the market has performed from